Where is the buyer demand and is the market stuck? We're going to talk about that today. Let's kind of review what happened at the end of 2024 in terms of listings going off the market and how we have begun the year in 2025 with these listings either coming back or staying off the market. And how does that compare to where we started last year? Because I have to say, I'm a little bit surprised on how the first 2 weeks of this year have played out. We're also going to talk about is the market stuck or not? There's some new data that I found surprising as far as the feelings and thoughts of sellers thinking about selling their homes. So let's jump into it. First, I want to talk about what the Cromford report is saying about Q4 of 2024. We reached a peak of 22,006 active listings without a contract across all areas and types in the MLS. And that was in November on the 24th. This then dropped to a low of 19,460 on January 2nd. So remember last week we were talking about the number of expired listings. That had a lot to do with this big drop. And so my question was, are these listings going to be coming back to the market, or will they remain off the market and we'll see a lower number of supply going forward? Well, although sellers were helped by the 12% reduction in competition that disappeared between Thanksgiving and New Year, they have little reason to be encouraged by the developments since then. So if you're a seller, listen up. We have seen these active listings grow again over the last 2 weeks. Now we're at 21,047. Remember, the peak in November was 22,000. So we have about 1,000 less than we did at the peak. We're only 4% below the November peak. And the current increase is around 4% per week. So we're probably going to regain that level within a week or so, according to the Cromford report. It's still not clear if supply is going to increase beyond this, but the point that they're making is that if we do get to 22,000 listings on the market, that's far beyond what we need for demand to pick up, which poses the question, where is demand? Because we'll talk about it, but these mortgage rates are not helping anything as it relates to demand. New listings are arriving at almost the same rate as they did in 2020, which is significantly faster than the intervening 4 years, according to the Cromford report. Our closed listings are around 5,000 a month, and year-to-date closings are down 12% from this time last year. We have 5,750 listings under contract. We started the year with 5,496 under contract. So the rise since the beginning of the year is only 4.6%. On January 13th last year, we had seen a growth of 13.2% in listings under contract by now. So almost 10% more last year at this time. So 2025 is actually starting out slower than 2024, which is somewhat surprising to me, only because, anecdotally speaking, for the number of folks that I've been speaking with and my team has been speaking with over the last couple of weeks, it seems as though a lot of people want to buy or sell in this market. We've had a number of meetings with new buyers and sellers, and I will say I have heard from a lot of sellers planning to list their homes on the market. So maybe that is something that we're seeing throughout the overall market, where we will see a lot of listings coming on the market, but not sure if that demand is going to keep up. Now, the Cromford report does say that it's pretty early in the year. It's hard to tell exactly where we're heading, but they're not expecting the CMI to make much progress out of the low 90s. And we'll look at the CMI and the contract ratio towards the end of this video. Right now, we're at 91.6. They say it would not surprise me if it fell back below 90 by the end of January, unless conditions improve significantly. Now, remember, anything below 90 on the CMI is considered a buyer's market. So basically saying we're on the cusp, and they won't be surprised if we go back into a buyer's market overall pretty soon, just because we're seeing more listings hit the market and that buyer demand is just not really keeping up. So where is the demand? Well, they are holding out and waiting for these mortgage rates to stop going up, because they just keep getting worse and worse every week. So what happened last week? Well, we had a higher start to this week week because of the jobs report that came out on Friday. The jobs report came out and it was, we added more jobs than expected. So the labor market is showing that it's stronger than expected. Now, will there be revisions to this? Yes, most likely. But that doesn't change the fact that the market reacted based on these numbers, which then impacted mortgage rates. So the expectations or the forecast for the jobs report was adding 160,000 jobs, but when the report came out, it actually showed that we added 256,000 jobs. So that is a seasonally adjusted number. So as I said, this could be revised. However, the market reacted to the fact that the labor market is showing more strength than expected. It also showed that the unemployment rate dropped slightly to 4.1% from 4.2%. The Fed is really aiming for 4.3% or higher before considering further rate cuts to the federal funds rate. So a lot of what happened, the word on the street is that the Fed is now going to delay the time frame until they cut rates again because the jobs report was hotter than expected. In addition, it also reignited concerns about inflation, which remains stubbornly above the Fed's 2% target. Traders are now expecting the central bank will wait until at least June to reduce its policy rate. Before the jobs data, they were betting the Fed would cut rates as early as May with about a 50% chance of a second cut before year end. Now, they also mention in here inflation, which is something that hasn't been as much of a hot topic lately as it was about a year or so ago, because we had seen some progress in inflation. And now a lot of what the Fed has been looking closely at has been the jobs report, the labor market. But we're kind of shifting back to looking at inflation again. And we're actually going to be getting the CPI on Wednesday. This video will have already been recorded by the time you guys have that information, so I don't have anything to share with you yet. However, just keep in mind, if the CPI comes in higher than expected, you will probably see rates move in a negative direction for home buyers. They will probably go up. If inflation does show progress and comes in lower than expected, then we may see some positive movement in mortgage rates. So keep that in mind as you're getting that news on Wednesday. There's also some additional news coming in later this week. So Thursday, we'll see retail sales and jobless claims. Friday, there's going to be housing starts and permits data. All of this can affect the market and can affect mortgage rates. So just something to keep in mind if you were in the process of buying a home, you're speaking with your lender, just make sure you're checking in with them, because rates, we don't want to see them going up any higher, right? So where are we at today? Let's look. 7.26%, and you can just see how ugly this graph is for the 30-year fixed mortgage rates. It has just been climbing and climbing and climbing. So a lot of people expected we would be starting the year in the sixes and maybe even low sixes, but unfortunately we're in the low sevens. So keep an eye on that. I know that's important for home buyers in terms of affordability. One thing I've mentioned every single week, and I will mention again, is assumable mortgages. That is a huge opportunity for buyers. If you're curious on how that works, check the description below. I have a guide where it will give you all the info about getting an assumable mortgage. You can also check the description below for a link to search a list of homes with assumable mortgages. Our team's been helping out a number of buyers looking for those types of properties, and we've found some ways to find some additional options that aren't listed in the search below. So feel free to send us a note if you are interested in getting more info on assumable mortgages. So what am I talking about here with the market being stuck? It's not the first time I have mentioned this. And by the way, if any of this is helpful for you, make sure you consider subscribing to become part of our community going forward. I'm here every Wednesday talking about the Phoenix real estate market. So according to Redfin, more than 1/3 of homeowners say they will never sell. This is not necessarily new news, but I have not heard these numbers in a while, and they feel pretty big, to be honest. So more than 1/3, 34% of US homeowners say they'll never sell their home, according to Redfin. Another 27% say they wouldn't consider selling for at least 10 years. Roughly a quarter plan to sell in 5 to 10 years, and only 8% plan to sell in 3 to 5 years. 7% within the next 3 years. So is anybody selling? I mean, how are we ever going to have inventory on the market if no one wants to sell their home, or if the shortest time frame for anyone is in the next 3 years? Inventory is just not moving. And why is this? Well, no one has a good incentive to move up or even downsize, to be honest, because if you do have to get a mortgage, your payment is going up either way. You can downsize and you can buy for less than you sell for, and you're probably still going to have a higher payment than what you previously had, assuming you got a great mortgage rate, right? And if you own outright and you are downsizing, or whatever the case may be, and you're getting a mortgage, that kind of sucks because that payment isn't going to look great. So point being, there's not a lot of incentive for sellers to sell their home if they have to buy something else, unless they really have to do it. There isn't as much of that, just convenient, I think I'll move, I think I'd like a different house if the numbers work type of moving anymore. It's kind of like, those numbers don't look pretty and we don't actually need that much more space, so let's stay put, or let's remodel or make an addition to the house. Those types of things are happening. Now, I know we have seen and talked about on this channel the silver tsunami, and I've given my opinion on how I feel about this theory that if you're not familiar, that all the baby boomers are going to die off and all of their homes are going to be for sale and home prices will come down because inventory will skyrocket. I don't think that is the way things will play out. And it's interesting because this article kind of contradicts that. The baby boomer effect is hitting the housing market hard. So when I first read this headline, I was like, oh, here we go, the silver tsunami. We're talking about it again. But we're not. This is actually about how baby boomers say they'll never sell. 43% of baby boomers, so that's almost half, say they will never sell their home, the highest of any generational group. And the biggest single reason cited for staying in place is that it's almost completely paid off, while others say they like where they live. 30% say they're staying in their current home because prices are too high. Does that sound familiar? And 18% said that they're staying because they don't want to give up their low mortgage rate. So again, same story with the baby boomers. I think it's interesting to see this because obviously we don't live forever, right? They will die at some point. But the plan, according to these folks, is like, we're not going to sell before we have to. And I would think more than likely they're going to give their home to maybe their children, grandchildren, whatever that looks like. If they plan to stay there for that long, those homes may sell off market or may stay in the family. It's not like all of these listings are going to be coming to the market. So I thought this was interesting, especially because it truly feels like the market is stuck in some ways. We don't have the buyer demand that is fueling a lot of transactions. And we don't even have, although we've seen more listings hit the market, we still aren't in a place where we're seeing an excess of listings. So it's that lock-in effect all over again. I know we haven't talked about it in a while, but it's still happening. And I think as long as mortgage rates are staying above 7%, this market is going to be very slow. So let's talk about what's happened the first week of the year. As I said, it's kind of hard to tell where we're heading, what direction we're going at this point, but we can at least see what the activity has looked like and compare it to how we started last year. So active listings without a contract, so these are just active on the market, they've increased 4.1% over the past week from 19,000 to 20,000. 19,776 to 20,583 to be specific. Listings under contract have increased 4.4% over the past week from 5,496 to 5,737. So the difference here is, active listings have increased about 4.1%, right? So more new listings on the market have not been claimed by a buyer yet. The number of listings under contract, so those are the listings that have been claimed by a buyer, an offer has been written and accepted, that's increased 4.4%. So we're seeing both more sellers listing their homes and more buyers out there that are taking those listings off the the market. The contract ratio has moved very slightly higher from 27.79 to 27.87. Remember, anything under 30 is considered a cold market, and we're still hanging out in there. But what is interesting is if we compare to where we're at last year. So I know I said, we don't have the demand and all of those things. Well, let's compare to what we're seeing from last year. Active listings have grown faster this year. Last year, they increased only 3.3% in the same time period. Listings under contract have grown slower. Last year, they increased 8.4%, almost twice the percentage that we're seeing. So when we look this year to last year, we're now seeing more listings hitting the market and fewer buyers actually putting those listings under contract. And last year we saw, fewer listings hitting the market and more buyers putting those under contract. So that is a little bit more heat or strength in the market than what we're seeing so far this year. As it relates to the contract ratio, last year this grew from 35.98% to 37.76%, adding 4.9% during the first week. And so, as I mentioned earlier, that contract ratio, 27.79 to 27.87, like barely any change with the contract ratio. So that is just the first week of the year. I don't have the full data for the second week of the year yet, but so far we're just trending a little bit slower and less exciting than last year, which is hard to say because last year was not great and the year before that was not great in terms of home sales. So if things don't change, we may be on pace to have the same boring year of low home sales all over again. So let's take a look at the Cromford Market Index. We're at 91.6. We already talked about this. We're just on the cusp of the buyer's market there. Demand at 76.5 and supply at 83.5. Again, these are measured by the Cromford report, and 100 is considered that normal range. And so demand is about 24% below normal, supply being about 17% below normal. Now, if we look at the CMI for every single city throughout the valley, you'll see a lot of green arrows. We are seeing this improve for sellers. The average change in the CMI month over month was 10.4%, and last week we saw a change of 8.8%. So we are continuing to see some strength for sellers. I think a lot of that is coming, these numbers are really reporting on the fact that we had a lower number of listings on the market and we still had some buyer demand out there. Now that we're beginning to see more listings hit the market, many of those being the canceled expired listings at the end of the year, getting relisted, some that were temporarily off market, coming back on market. We'll see, because I have a feeling that our supply is going to outpace our demand probably for the next couple months. If you're a seller on the market right now, I think it might be a little bit slow until we get to the end of February. So just keep that in mind. But if you're curious as a seller what your contract ratio is in your zip code, check the description below to request that information. I can pull that for you because this gives us a little bit of a more like real-time number of what's going on in these areas. You can see we have a couple hot zip codes or warmer zip codes here. Tempe 85284 is on that end. And then we also have Chandler 85224 and Tolleson 85353, which is not new, of kind of those like warmer zip codes, meaning that there are fewer homes for sale and more buyers actually taking those homes off the market. But you can see a lot of green and a lot of blue. Both of those indicate either a balanced market or a cold market. And overall, that contract ratio is under 30, meaning we are in a cold market technically across the valley. So sellers, if you want to know what's going on in your zip code, check the description below for that. Agents, if you're watching this and you're thinking about joining a team, email us. I would love to speak with you further. We are expanding our team and I'm talking with great agents throughout the valley. I will see you guys next week on my next market update. Have a wonderful week.